Hi everyone, welcome to Bill's Market Insights. Over the past year, tech stocks has been on absolute tear, skyrocketing 60%. It's enough to make everyone's mouth water, but it's also enough to make your stomach churn. The question every investor is losing sleep over right now is, am I catching the last wave of the greatest bull run in history? Or am I about to become the greater fool, buying at the very top? I know what some of you are thinking. I'm playing it safe. I didn't go all in on Nvidia. I'm just sticking to my old and faithful S&P 500 index fund for my 401k. Well, let me throw some cold water on that. You think you're diversified and safe? Think again. There's a high probability that you're unwillingly bet your net worth on the AI chips. Market indices today are nowhere near as diversified as they used to be. Let's chat in the comment section. How much of your portfolio is actually in tech? If you have realized that tech makes up more than half of your holdings, drop a 1 in the comments. Let's see how many of us are investing heavily on tech. In business, the fastest way to go broke is for your equipment to break down before it even pays for itself. Capital investment in AI right now looks a lot like treadmill trap. You're running at full speed, sweating bullets, but you're not actually moving forward. Why? Because there's a massive invisible money pit under the hood. In 2026 alone, big tech is projected to dump over $1.5 trillion into AI infrastructure. Where's that money going? Into the world's most expensive chips and astronomical electricity bills. But here's the kicker. These chips that cost $40,000 a pop have a technical shelf life of only about 3 years before they are obsolete. Imagine you open a restaurant and buy the most expensive high-tech oven on the market. But the oven has a glitch. It's guaranteed to die in 3 years and is unfixable. If you can't sell enough pizzas to pay off that oven before it hits the junkyard, you don't have a business. You have a disaster. That is the AI risk today. Companies haven't figured out how to monetize the software yet, while the hardware is depreciating into expensive paperweights. If you buy a company that just hauls chips but doesn't generate cash flow right now, you aren't an investor. You're just subsidizing their scrap metal. We used to believe that he who has the most chips wins. We thought hardware was an unassailable moat, but that moat is drying up fast. Recently, a firm called DeepSeek released an AI model using new training techniques that proved something game-changing. You don't need to throw infinite money at hardware to win. Smarter algorithms can do the job better. It is like thinking you need to lease a Ferrari to deliver pizzas just to stay competitive, only to find out your neighbor is using a fuel-efficient scooter and getting there faster than you. The logic has shifted. The brute force computing is no longer the only way to win. Those stockpiles of expensive Ferraris aren't assets anymore. They are liabilities. The power is shifting from the hardware sellers to the harvesters, the companies that can actually turn AI into cash. If you're still clinging only to overvalued hardware stocks, you might truly be the one holding the bag. So facing the 60% temptation on one side and the cliff on the other, what do we actually do? Here's my survival plan to protect your downside. Number 1. Do a look-through audit. Most important for your 401k. Don't assume your index funds are safe. 1/3 of the S&P 500 is now tech. Do a look-through on your SPY holdings and calculate your true tech exposure. If you have those funds and then go out and buy another 25% in AI stocks, you're dangerously over-leveraged. If tech wobbles, your presumably diversified investment goes down with it. Number 2. Distinguish long-term and short-term bucket, regardless how much you love your AI. I recommend capping your long-term core tech holdings at 25% of your total portfolio. If you want to play the momentum or reversal for short-term gains, keep that total exposure under 50%. Never let your hopes exceed your risk tolerance. Number 3. Use a hard asset as anchors. To hedge against the digital bubble, you need some skin in the physical world. Number 1. Gold. The ultimate insurance if the power goes out on the tech narrative. Gold is still gold. Number 2. Copper. The literal backbone of the AI power grid. As long as AI needs electricity, the world needs copper. Short-term treasuries. Keep enough cash for liquidity. If the market turns ugly, you want to have dry powder to buy the dip. Number 4. Strategic shift. If recession risks start to climb, consider moving some of those short-term treasuries into long-term bonds. Making a quick buck is great, but staying in the game is better. The past year's 60% gain might have been the trend, or it might have been luck. But surviving this year and next requires a strategy. Do you want to be the one running on the AI treadmill until you collapse, or the smart investor who knows when to step off, take profits, and stay resilient? Final homework. If you had 100,000 cash right now, how would you split it up based on the logic we discussed today? Remember to account for the tech hidden inside your SPY. Share your allocation in the comments. For example, tech %, non-tech %, bonds %, gold, copper %, cash %. I'll try to jump in and give some feedback on your setups. This is Bill's Market Insights. Don't forget like, comment, and subscribe. And if you found this helpful, please share it with a friend. I'll see you in the next one.